All right, let's talk about a single number that can completely change how you see your business. It's called the contribution margin. And if you've ever had that nagging feeling, wondering which of your products are really making you money and which are just, well, keeping you busy, this is the metric that cuts right through the noise.
So let's get into it and see how this amazing tool really works.
You know the feeling, right? Your sales numbers are through the roof, the team is flat out busy, and on paper, everything looks fantastic. But then you look at the bottom line at the end of the month and you're just scratching your head wondering, where did all the profit go? That's the profitability puzzle. And believe me, it trips up a lot of businesses.
I mean, this is the million-dollar question, isn't it? Just looking at your total revenue is a bit like staring at your car speedometer without ever checking the fuel gauge. Yeah, you might be going really fast, but you could be just moments away from sputtering to a halt. If your costs are secretly chewing up every sale you make, you're not actually moving forward, you're just spinning your wheels.
And this gets even trickier when you sell more than one thing. How do you tell your superstar products from the ones that are just dead weight? It's so easy to have a product that flies off the shelves, everyone loves it, but it barely makes you a dime. Meanwhile, some other slower-selling item is quietly the real workhorse of your business. Without the right lens to look through, you're basically flying blind.
But what if I told you there was a tool that works like a financial X-ray for your company? Something that lets you see the hidden profit inside every single sale you make. Well, that tool is real, and it's called the contribution margin.
Okay, so what is it exactly? Think of it like this. For every single thing you sell, some of that money has to immediately go to cover the direct costs of making that one item. The stuff you're left with after that, that's your contribution margin. It's the money that contributes to paying all your big, unchanging bills, like rent and salaries. And once those are all paid off, every single dollar of contribution margin from then on is pure, straight profit.
I love this analogy on the slide because it's perfect. It really is like a safety net. The bigger your contribution margin is, the more of a buffer you have. It gives your business resilience. It's a clear indicator of how much each sale actually strengthens your company's foundation and protects you when things don't go exactly as planned.
Now, to really get a handle on contribution margin, you have to get this one simple distinction: the two types of costs. First, you've got your variable costs. These costs go up and down directly with how much you sell. Think of the flour for a bakery or the cost of wood for a furniture shop. You sell more, you spend more. Simple. Then there are fixed costs. These are the bills that show up every single month no matter what. Your rent, your insurance, your admin salaries. You have to pay those whether you sell one item or 1,000. The real magic of contribution margin is that it cleanly slices these two apart.
Okay, theory is great, but let's get our hands dirty and make this real. How do you actually calculate this thing? It is way simpler than it sounds, I promise.
It's really just a simple three-step recipe. You take your total sales revenue, you figure out all the variable costs tied directly to those sales, and then you subtract one from the other, boom. What's left over is your total contribution margin.
Let's walk through an example with Irwin Bread Manufacturers. So, they sell a packet of bread for 16 bucks. The variable costs for that one packet, we're talking flour, yeast, the bag it comes in, direct labor, that all adds up to $4.50. So when they sell 1,000 packets, their total sales are $16,000, and their total variable costs come out to $4,500.
And when you subtract that variable cost from the sales price, you get this number, $11.50. This is the magic number. This is the contribution margin per unit. It means that for every single packet of bread that goes out the door, Irwin Bread generates $11.50 to help pay for the factory rent, the manager's salary, and all those other fixed bills.
Now check this out. What happens if they have a great month and double their sales to 2,000 units? Well, of course, the total revenue doubles and the total variable costs double. But look at that per unit column. The price is still $16, the variable cost is still $4.50, and the contribution margin, it's still a rock-solid $11.50.
And this right here, this is why this metric is such a powerhouse. Your overall profit per unit might change as you sell more, right? Because you're spreading your fixed costs out over more items. But the contribution margin per unit, that stays consistent. And because it's so stable, it becomes an incredibly reliable tool for planning and forecasting. This concept is so useful that there's an entire type of income statement designed around it. A traditional statement usually groups costs by department, like marketing or sales, but this one does something different. It splits everything into either variable or fixed costs.
This layout immediately shows you the total firepower your sales are generating before you even have to think about your fixed overheads.
Let's apply that to Dobson Books. They brought in $200,000 in revenue. After they paid for the variable costs of those books, $80,000, they were left with a very healthy contribution margin of $120,000. Sounds great, right? But here's the big reveal. Their fixed costs for the month were $150,000. So that contribution margin just wasn't big enough to cover everything, and they ended up taking a $30,000 loss. This format makes the root of the problem just crystal clear.
Okay, so now you know what it is and how to calculate it. But what do you actually do with this information? Well, this isn't just some boring accounting exercise. This is a strategic weapon for making much smarter decisions in your business.
Seriously, with this one number, you can start to answer some of the toughest questions you face. How low can I price this new product? How many units do I need to sell just to break even for the month? Which product should I pour my marketing budget into? And maybe more importantly, which one should I think about dropping altogether? Can I afford to give a big new client a special discount? Contribution margin gives you the hard data to answer all of these questions with real confidence.
And once you've really mastered the basic idea, there are a couple of related concepts that can take your analysis to a whole other level.
First up is the contribution margin ratio. So instead of looking at a dollar amount per item, this gives you a percentage. It answers a simple, powerful question. For every single dollar that comes in the door from sales, how many cents are actually left over to contribute to my fixed costs and my profit?
So if we jump back to Dobson Books for a second, we just divide their $120,000 contribution margin by their $200,000 in sales, and that gives us a ratio of 60%. What this means is that for every dollar's worth of books they sell, 60 cents is generated to help pay down their rent, salaries, and other fixed expenses. It's an absolutely fantastic way to compare the raw profitability of different products or even different departments.
And okay, here's a really sharp next-level concept for when you have a limited resource, something called a bottleneck. Let's say you've got one specific machine, and every single product has to go through it. Now look at these two bikes. Bicycle A has a way higher contribution margin per unit, right? $100 versus just 60 for Bicycle B. So you'd think, obviously, I should make Bicycle A. But what if it takes twice as long to make on that one critical machine?
Well, when you calculate the contribution margin per hour of machine time, the entire picture flips on its head. Bicycle B, the one that looked less profitable, actually generates $120 per hour for that limited resource, while Bicycle A only generates $100. By focusing on the contribution margin relative to your biggest constraint, you can maximize your company's overall profit. It's just a brilliant example of how deep this analysis can go.
So, we'll leave you with this challenge. Go run the numbers for your own business. Calculate the contribution margin for every product you sell. I guarantee you might just be surprised to discover which one is your true MVP. Thanks for joining us for this explainer.